Hello, my name is Steve Balch. I'm the Director of Wealth Management and Financial Planning here at Certa Financial Planning, here to give you our monthly update for March. From a macro scales update, not much has changed. The market trend continues to be positive, with February making it 4 straight months for the markets with a positive return. Historically speaking, there have been 14 times the market has been positive for November, December, January, and February. Each time this has happened, the market has finished higher 14 times. The Fed continues to hold rates steady as they assess economic data. The current expectation is that the cuts will start in June at the earliest. For now, the policy continues to be neutral. Fiscal policy. Fiscal policy continues to be positive. The government continues to run large deficits, with the deficit expected to be 6.8% of GDP in 2024. Historically, when the deficit has stayed above 5%, this has acted as a stimulus for the economy. Leading economic indicators. The job market continues to be strong, with the 4-week moving average of initial jobless claims staying in the low 200,000 range, while wage growth is hovering around 4%. January saw the economy add over 350,000 jobs, well above expectations. Additionally, many of the leading economic indicators that have been declining for months are starting to turn around. This has given us a positive stance. Valuations continue to stay neutral. Global market valuations continue to be attractive compared to historical valuations. The only market with a higher valuation continues to be the U.S. large cap market. In the market regime, we continue to be in a Goldilocks regime, which is positive for the markets, and why we continue to be positive in our outlook. One thing to note, our internal research did switch to a deflationary signal in our 6-month forecast. This is not a panic signal, but it's something we will watch, as we may have some headwinds arise in the second half of 2024. For the business cycle, we continue to be in the late stages. These are the 3 questions we are monitoring. In like a lamb and out like a lion. Is inflation still an issue? Leading indicators misleading. The old saying from March is in like a lion and out like a lamb. Typically, it starts really rough with weather and then smooths out at the end. After a strong February in which the markets returned over 5%, what does March have in store? February's gains marked the 4th straight month of positive returns. This was only the 11th time February has seen a 5% or more gain since 1928. The chart shows how March performed after a strong gain in February and how the markets did for the remainder of the year. As you can see, the results are a mixed bag, with the most recent strong February in 2025 resulting in a negative March and a negative remainder of the year. Time will tell how the markets react to this February's positive return. Is inflation still an issue? While personal consumption expenditures, PCE, inflation numbers came in line with expectations, a deep dive shows inflation is still an issue. The Fed's closely watched index, the super core inflation, rose 0.6% month over month after seeing moderate increases the previous 2 months. On a year-over-year basis, the index ticked up 3.45% from the 3.3% the previous month. In late 2022, Powell said that core services other than housing, i.e. super core services, may be the most important category for understanding the future evolution of core inflation. In the Fed's views, prices for these core non-housing services, including things like healthcare, haircuts, and hospitality, better indicate the direction of prices in the U.S. economy. Additionally, the super index focuses on wages. Since wages make up a large percentage of the cost for services for businesses, the Fed can get a better idea of the impact of wages on prices. The bottom line is, this jump in supercore is a factor to watch. The market has already pushed back their expectation of a rate cut and expects the first cut to happen in June. If the data around supercore prices continues to come in higher than expected, the narrative around rate cuts for 2024 may start to change. Leading indicators misleading. The leading economic index has declined for 22 straight months. This is the longest streak since 2007-2008. However, the decline in January was the slowest pace since last March. Additionally, there is reason for optimism as 6 of the 10 components in the index have turned positive over the last 6 months. We will watch the reading for February, but if the LEI changes less than January or even turns positive, this could be very bullish for the markets. Our positioning and outlook. The S&P 500 has returned over 20% the last 4 calendar months. The previous 15 times this happened, the S&P 500 was higher 6 months later and 1 year later, all 15 times. In February, our internal models fluctuated between overweight and neutral readings on our growth strategies. Since the downgrade recommendations were barely neutral, we continue to hold steady and wait for a reading that had more conviction. As this updates, our models and research have an overweight reading on growth strategies, keeping us positioned like we have been for the last 3 months. For now, we continue to stay in the upper bands of our growth strategies, keeping total equity exposure toward the top ends of clients' risk tolerances, while maintaining a neutral stance towards cash and preservation. Lastly, we continue to be underweight in tactical and alternative strategies. We understand that after 4 straight months of positive returns, the market rally may take a breather. If adjustments are needed to be made, we will act accordingly and continue and keep you updated. For now, we continue to follow the trend and we are positive on the market outlook. We thank you for watching. As always, please feel free to forward this to anyone you believe can benefit from the information. If you have any questions, please feel free to reach out.